Well, Australia's housing markets rebounded again last month, led by strong price growth. Now, two big capital cities, Melbourne and Sydney. Since bottoming out in June earlier this year, the National Dwelling Index has recovered strongly. Home buyers are back. Sellers are finally putting properties up for sale. First home buyers are back, getting a foot on the ladder. And investors, well, they're slowly returning, maybe not at the numbers that we've seen them before. They're all buoyed by falling interest rates, the prospect of another rate cut or maybe even two next year, less stringent lending criteria. And this is now the fifth consecutive month of price gains in Melbourne and Sydney. And that's obviously the states where the downturn hit the hardest a couple of years ago. As a result, auction clearance rates are on the up, asking prices are on the up, property values are increasing, and some property commentators are even forecasting double-digit capital growth next year. However, our property markets are fragmented. Not all markets are performing the same. So to explain what's really happening in our property markets and to give us his forecasts, let's have a chat with Australia's leading housing economist, Dr. Andrew Wilson, Chief Economist of myhousingmarket.com.au. Hello, Andrew.
Hello, Michael. How are you today?
Good. Well, another month and we're now almost at the end of the year.
Yes.
Let's start with the big picture. If you're looking at the world economy, Andrew, doesn't look like a lot has changed in the last month. The US-China trade tensions and the uncertainty about Brexit still continue on. They still take their tolls, contributing to weakness in trade, weakness in production. Economic activity in the United States has also decelerated, prompting the third interest rate cut in October. And recently, the International Monetary Fund reduced its global growth forecasts. We're not going to have a recession, but the world economy seems to be slowing, Andrew.
Yes, Michael, but I think we've got a little bit more positivity now in respect to some of the negativity that was, I guess, open discussion a few months ago in regard to the world economy. Of course, we had a lot of focus on that inverted yield curve, whether that was precursor to a recession sooner rather than later. I think that's now off the agenda in terms of a negative headline. There's improved prospects now looking to come out of the US. Certainly not a boom, but it looks like it's still a more steady economy rather than a declining economy. And some of the key points have been a little bit better. And as I said, we've now moved beyond that fear of the recession, which was supposed to have been indicated by that inverted yield curve.
Well, back home, the latest economic data must also be a concern to the Reserve Bank, Andrew. There's been no bounce evident from its three recent rate cuts. The jobless rate's rising, unemployment is creeping up a little, wages growth is declining. What's your take on the Australian economy, Andrew?
Well, it's certainly now clear that the economy is declining, Michael, from what was a reasonable performance, particularly of the labour market. We had higher unemployment rate with the latest data, of course, and the concern really wasn't necessarily the unemployment rate. It was the fact that we actually lost jobs for the first time in quite a considerable period. Obviously, this is a precursor for more interest rate cuts, Michael. I think that unless the data improves, we will get a cut in February or March. The Reserve Bank has clearly indicated that it's prepared to go down to maybe 0.25. And I'm not sure that'll have the expected effect or hoped for effect on the economy, but it'll certainly be a positive for our housing markets, no doubt about that.
The Reserve Bank, or its governor, Philip Lowe, came out clearly saying that they're prepared to lower rates to 0.25% and even discuss the possibility of initiating quantitative easing policies if that isn't enough. It's clear, though, over the last little while that it's increased government spending that's been vital to keep our economy afloat. Yes. Contribution to the government spending and investment is now nearly at the levels it was in the global financial crisis. On the other hand, Victoria's economy is actually punching above its weights, but the other states are struggling a bit, Andrew.
Well, it's interesting when we look at the capital city labour market data, Michael, it's actually quite concerning. We've seen a sharp rise in unemployment in Melbourne and Sydney over the past year. And we've also seen, particularly in Sydney, a sharp decline in jobs growth, which was quite strong. But again, that reflects the national environment. We're now starting to see fewer jobs being created, and that's creating higher unemployment. And that's not the mix that the Reserve Bank wants. And it is part of the easing of the business cycle that's now clearly underway, Michael. And I think that's got some way to run. And again, it works towards lower interest rates, but of course, as you suggested, more government spending, and that will be the key to reinvigorating the Australian economy.
Andrew, you mentioned unemployment and the lack of job creation, there's another issue, and that's the lack of building approvals, which is going to mean that the current jobs, as the large projects finish off, people are going to have difficulty finding new employment.
Absolutely right, Michael. Those October building approval numbers from the ABS were quite sobering. There's really no sign of a revival in the residential construction industry, which of course is a very strong driver of employment, particularly apartment construction. Figures were dreadful for planned apartment construction over October. Sydney apartment approvals were below 1,000 for the first time in nearly 10 years. And the overall number for apartment approvals in all the capital cities was also at a near 10-year low. So there's really no sign of a revival in that very important apartment sector, which was a key driver of our economy post the end of the previous mining boom. Those numbers were very sobering, Michael, and it's going to lead to an undersupply of property down the track. It also will mean that where do we get the jobs from to reinflate the economy?
Well, I guess it means it's an unrealistic target in the short term anyway, as we're going to get more job losses in construction and probably also in the retail sector after Christmas as well, Andrew. And I guess that means that interest rates are going to remain low for some time and keep dropping, as we've said. But that's also on its own created some concern. Australians are not spending, they're stashing their cash, they're uncertain about their financial future. Similarly, businesses seem hesitant to invest due to uncertain local and global economic issues.
Well, these things feed each other, of course, Michael. And when demand falls, of course, confidence falls, particularly in business. And as you said, the hard yards are still ahead for the retail sector. I think that the point that those interest rate cuts and the income tax cuts really haven't worked as they were expected to work reflects in a way that Australians are using that extra income to pay off debt. Either they're paying down their mortgage or their credit cards, but they're certainly not spending it, which is what the plan was.
Well, there is some good news. We shouldn't sound so negative because our property markets are performing very well.
Yes.
Auction clearance rates are up, values are up, prices are up, asking prices are up. Let's work through each of those in turn. Auction clearance rates are one of the things you regularly monitor because it gives us an in-time indication of what's going on.
Yeah.
And auction clearance rates in Melbourne and Sydney have been really firm over the last month. We're looking at the graph of Sydney at the moment where the trend is very positive, isn't it, Andrew?
Oh, absolutely. This is a good old-fashioned boom, Michael. We've seen clearance rates really peaking now at around 80% over the past month or two. Really haven't looked like moving. And the interesting thing about the auction market in Sydney, Michael, is that auction numbers have actually picked up. So sellers predictably have gained confidence in the market as clearance rates have remained high and prices have risen. And we're now starting to see numbers now in excess of where they were a year ago. We always see numbers rise in late spring anyway in auction markets, but now we're tracking above in Sydney where they were a year ago. But typically that late spring market starts to ease in terms of clearance rates as more stock comes into the market. But we're not seeing any sign of that, which is really reflecting the buyer depth in the Sydney market, that despite higher numbers of listings, we're still clearing auction sales at the same rate, the same boom time rate as we have for most of spring. And of course, that means higher prices. As you said, there's a clear correlation between auction clearance rates and prices. And we've seen some really extraordinary numbers over November, quite extraordinary, the level of prices growth in Melbourne and Sydney. Interesting, Melbourne hasn't had quite the same result in terms of clearance rates. It's settled around about the mid-70s. But again, these are unequivocally good results for sellers. Those numbers in Melbourne and Sydney that were released recently by CoreLogic, which showed 7% growth over the November quarter for each of them, are just quite extraordinary. In fact, we have to go back to the late 1980s, Michael, to see anything like that. Now, the question is whether this is sustainable going forward. You've got to understand that if we multiply those 7% results by 4, that's 30% a year. So I think that we're still in catch-up mode in Melbourne and Sydney in terms of, still being behind where prices were 2 years ago. But we're certain to these levels of growth to recapture peak levels of prices within the next quarter or two. And then it'll be interesting to see whether the market can continue to drive at these rates. I doubt it, because we would have seen the bottom of interest rates by then. highly likely. And of course, incomes growth is still basically in second gear.
Well, vendor metrics are up as well. It's taking less time to sell a house.
Yes.
Vendors are needing to discount their houses less to get a sale. All this is a sign of the strength of our markets and encouraging people to put their houses on the market, because buyers are sellers and sellers are buyers. So people selling their houses want to know they can move somewhere. So it looks like the last few weeks of the year are going to finish strongly, as will next year. I've now got on the screen here your asking price index.
Yes.
Let's have a quick look through that, please.
The interesting point there is Sydney up marginally over the month. You've got to understand these are asking prices over the month. They can tend to be volatile. Sydney was up marginally over November. Melbourne up quite, certainly stronger at that 1.6%. But the interesting thing was that Brisbane is starting to show a revival, which was also reflected in some of those core logic numbers as well. The other market that's shown a revival is the Canberra market, Mike.
Well, Sydney's housing market's on track to recoup its 15% loss in the first quarter of next year, and Melbourne probably will recoup its losses even sooner. And then it'll be interesting to see, because when they reach their peak, in my mind, it's not likely they're going to keep getting this double-digit annual growth rate, because there are still going to be some economic headwinds, as we said, and also finance is going to be an issue. If we get double-digit growth, it's quite likely the regulators will step in again. I don't think they're going to rush in as quickly. Maybe they learned some lessons from their errors last time round, Andrew.
I don't agree with you, Michael. I don't think the regulators will come anywhere near the housing market, particularly because we don't have the investor drive into the market that we've had previously. These are owner-occupiers that are fueling this market growth at the moment. So they're either bringing trade-ins into the marketplace, which means they have loans that have relatively higher amounts of equity in them, so they have lower risk profiles. And that, of course, was the concern for APRA. We still have very low numbers of investors involved in the market. And we also have parts of the market that are still underperforming. Apartment sales are still quite slow in some parts of Sydney and Melbourne. And yet we have this extraordinary prices growth, which hasn't been contributed to in any degree really by investors. Now, again, whether this is an issue of investors still being a little wary of the market or the difficulty in investors finding finance, which I think is the story, remains to be revealed.
Well, that makes a much healthier market. And Andrew, you're right. Our sense on the ground is that investors do want to get in the market. There's the fear of missing out again, but you're correct that they're actually having much more difficulty getting finance. So finance is the bottleneck.
Yes.
So while house price markets have been, well, booming, to be blunt, over the last 5-6 months, the rental markets have been different and a bit fragmented, Andrew.
Yes, look, that's correct, Michael. And one of the factors, obviously, has taken demand away from rental markets. Well, two factors. Firstly, we have seen a surge in first home buyer activity. First home buyers were quite strong a year, 18 months ago, when stamp duty conditions were changed in New South Wales and Victoria. That predictably started to ease this year. But once prices started rising again, first home buyers have rushed back into the market, particularly in Melbourne and Sydney. Of course, they're fearful that prices will eventually constrain their capacity to save a deposit. Makes it harder when prices are rising to keep up with the market. And more first home buyers means less demand for rental properties, of course. And we have also seen decline in Victoria and New South Wales of what was in recent years very, very strong population growth, migration. And fewer migrants, of course, means, less demand for rental properties. And we've had a lot more new apartments into the market as well. So less demand, more supply has obviously impacted vacancy rates and rents. And we've seen that particularly in Sydney. Sydney vacancy rates are continuing to climb, Michael, particularly for apartments. And we've seen rents falling. Rents in Sydney are now down 10% over the past year for both units and houses. And the other markets are reasonably steady in terms of their rental outcomes. Again, we'll see more first home buyers in the market next year with that first home buyer deposit policy when that comes into act. So that will take some demand again out of the market. And of course, we're still seeing apartments coming into the marketplace. So I would expect rents to pretty much continue to move sideways and vacancy rates to remain perhaps a little easier rather than tighter.
Well, that's the roundup for the property markets for this month. We've had the fastest housing rebound in 16 years. Sydney and Melbourne are leading the way, and it's the beginning of the next property cycle, Andrew.
Well, yeah, Michael, I still think we're talking catch-up energy here. When we look at the smaller markets, they're not growing anywhere near as fast, although some early signs that Canberra and Brisbane are picking up, but not at that level that Sydney and Melbourne are.
Well, a year of two halves. Who would have thought at the beginning of the year we'd be having this conversation, Andrew? It'll be interesting to see what conversation we're going to have this time next year. Thanks for your time once again.
Thanks, Michael.